And live from the Inside ETFs conference in Hollywood, Florida, I'm Bob Pisani. This is ETF Edge, joined today by Tom Lydon of ETFtrends.com, Rick Edelman of Edelman Financial. This is the largest ETF conference in the world, so let's start with some of the hot topics dominating the conversations here. One of the most obvious themes, global growth fears. I would say that's number one right now. It's been in the front of mind for investors for many months now. Then you have advisors giving different ways to beat the markets this year. That's a staple. And of course, another trend in the world of ETFs has been the race to zero fees. Rick, let's start with you. You gave the keynote speech last night. What are some of the themes that you think are going to matter to ETF investors this year?
Well, focusing on trends of the future, and it's all about technology. In a word, it's longevity. That changes everything. So the advice that planners are giving is going to morph into the investment management arena. What companies are going to be positioned to thrive in the 21st century? Companies built for success last century are not going to be dominant in the 20th and 21st century.
Well, philosophically, that's correct. But how does that attach to the ETF business? What's going to fail and what's going to succeed?
Well,
and what do they have to do?
We're going to see technology-oriented ETFs, those specifically in exponential technologies, dealing with everything from AI and robotics, big data, to neuroscience and bionics and bioinformatics. We're going to see a lot of companies emerging, and the ETF marketplace is really taking a much better view of this than the mutual fund arena, where they're recognizing the importance of these trends. And you're seeing products from Kensho and State Street, ARK Investments, BlackRock's XT ETF, all recognizing that there are huge opportunities in this theme, and they're providing these to their retail investors.
Tom, you're good at spotting these ETF trends. Technology, as Rick notes, is going to be hot this year, but we could have expected that. What other themes are we seeing? For example, we're continuing to see environmental, social, and governance, ESG themes out there. Some people are emphasizing quality. We have to abandon buying market cap weighted ETFs and look for those that are raising their earnings as the way. What do you see people talking about?
On those two, first of all, ESG is getting a lot of conversation. We're not necessarily seeing the flows yet, but this is a long-term trail that I think we'll see. As far as factors, we are moving, there's a shift on from momentum and growth stocks to quality and factor stocks. And a lot of companies are offering individual factor ETFs and even multi-factor ETFs that will offer up these strategies within the ETF wrapper so the advisor and the investor doesn't have to do that themselves.
I'm sorry, though. I don't know how you feel about it, Rick, but this term quality is one of those fuzzy words that I can't figure out what exactly it means.
Yeah, I think you're going to see it as just the fad of the day, and in a year you're going to be saying, whatever happened to that quality push? I agree with you. It's just a new way to describe something old. You always want to be buying into companies or ETFs that are buying into companies that are high quality. I mean, I've never seen anybody say, no, I think I'm going to look for the company that's about to go bankrupt. I mean, you're right.
But high quality sort of generically means you're growing your earnings, and maybe there are some internal value metrics that work on it.
At the right price.
I agree.
So just taking the other side of that, we haven't had a real good bear market in a while. So 10 years ago, during the financial crisis, there was fundamental indexing that was alive that did not give as much back and actually bought into financial stocks and tech stocks at the bottom of the market. We need to see something like that happen where we can see factor strategies, multi-factor strategies actually put up better numbers than the S&P 500.
And it's not just the crash of '08 where we had that last opportunity, but we used to have something called rolling recessions where there'd be pockets of the marketplace that were doing poorly at a given moment. These days, over the last several years, everything has been pretty much everywhere doing similarly. And we haven't seen huge outliers, either high or low, and it has created challenge for investors to try to find the next, what's hot and what's not.
Yeah, it's a difficult situation. But I think the key point here is you can get some differentiation, though. But you're sticking to thematic themes. You've been on go into technology companies that are changing the way the world looks. You were a very early investor in the XT. You're a major seeder of the XT at that point. So you've been consistent, at least on your themes. The problem I have with this every year coming here is this year it's ESG, next year it's quality, and it's very hard to sort of jump around and figure out. I see some flows going in, and then I see them going out. It's very hard to make that call.
I think the main point, Bob, is we're moving past market cap weighted traditional legacy
That
indices. And there's more choice, whether it be themes, whether it be factors, whether it be alternative strategies.
God has not ordained thou shalt buy market cap weighted indices,
Right.
but there's also not a lot of evidence that other alternative weightings necessarily outperform over long periods too. This is what I say about the smart betas.
It's all diversification.
Yeah. Let's move on, talk about some other things. One idea that's emerged from the conference is the potential for big tech companies to enter the investment management ring. This is a great subject, whether it be Apple, Amazon, Alphabet, even Alibaba, who, by the way, launched the world's largest market fund, money market fund. The chatter here is that as investing becomes increasingly automated, distribution will be the biggest challenge for the industry. That's where these tech players come in. They have the distribution. Our friend Dave Noddick of ETF.com says this could happen in a number of ways, from acquisitions, for example, to robo-advisors or a subscription-based service. The sky is the limit for these companies. Rick, how could this disrupt the industry? Could Apple become an ETF provider, an investment provider? Could Google launch its own ETFs?
With the amount of money they have sitting in cash, they could do anything they want. They could buy whoever they want. They could invent whoever they want to compete against. And this is true of Alphabet, it's true of Microsoft, it's true of so many of these big companies. Jeff Bezos could wake up one day and decide, hey, I want to go do whatever I feel like going to do.
But Tom, this is not easy. There is a fiduciary obligation.
Sure.
There's legal issues. You're dealing with the SEC. This is one of the reasons they didn't set up banks, for example. You have to deal with the Office of the Control of the Currency. You say that's not a big issue.
Well, they'll realize look, if B of A could handle the regulatory issues, so can Alphabet.
Yeah.
So they'll get over it.
It'll probably be the form of an acquisition. We interview and survey advisors all the time. The number one tool they use for research is Google, right? So there's a big trust there. However, I'm not sure if I would put money in a Google bank right now or a Google investment company.
Yeah, but your kids might.
Kids might, sure. Well, I'd look at SoftBank. SoftBank's got all the data in the world. They know if I go to the gym. They know my prescriptions. They know I like red wine. They know I like 80s music, because they're aggregating all the data out there. They've got a $100 billion venture fund. I'd bet on a company
And so
like
here's
that.
another element to this, and it's brand and reputation. Everybody knows that everybody hates the financial services industry. We hate insurance companies, credit card companies, banks, brokerage firms. So if one of the tech companies...
Increasingly, we hate Google.
I think we're increasingly hating Facebook,
we hate Facebook
more, right? So I think there might be a reputational challenge there if Zuckerberg decided to buy a bank, but I don't know that Google would have that challenge. And so I think that there is a huge opportunity, especially with the younger generation. Yeah. So I wouldn't at all be surprised to see them one day enter the space.
Do they really want to do everything, though? I mean, this is this debate about, I call it the app that ate all the apps. So in the messenger apps now, we're getting, in China, you can order food through the messenger apps. You can send money through the messenger apps. You can have items sent to you through the messenger apps. What happened to the individual ones that did this? They were all rolled up. The app ate all the other apps. Or is Google really, is Amazon really going to want to become the thing that is everything to everybody?
It's not going to be Google. It'll be a Fidelity. They're privately held, something like that. Google will come in and buy them up, but use all their data and their technology to really plug in and do the best job possible.
The only thing we know is that they're not talking, and it's keeping the financial service executives awake at night worrying about it.
They should. I mean, let's give an odds on this. In the next 5 years, what percentage odds would you give one of the big companies we're talking about, Google and Amazon and Apple?
Inevitable.
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 Yeah.
Inevitable.
I'm with Rick.
There's too much money there.
In the next 5 years, you think the chance of one of these companies coming in is virtually 100%.
And as soon as one of them does, they all do.
All right, that is a major statement. We'll keep an eye on that one. Now, let's end with your picks for the best new exchange-traded funds of 2019. Tom, you're looking at communication services. Now, this was essentially rolled up from last year in the changes that were made here.
So GICS had a new sector naming issue going on where they removed telecommunications sector, made it the communication sector. If you look at the lineup, it's stuffed full with cap-weighted FANG stocks, but it's got over $4 billion in it. The expense ratio is 13 basis points. As you know, we're going to go on stage tomorrow and battle it out as far as the best new ETF. It's innovative when you go back and look how many times has S&P actually changed sectors. Not that often. This is the sector of the future. Out of all cap-weighted sectors, it's number 2 compared to financial services.
Alphabet, 23% of the weighting. Facebook, 19%. Two companies are 42% of the weighting. This is what we constantly warn people about, market cap weighting. And when you get those kinds of companies, it distorts the whole the whole picture.
It's the majority of the way people invest today. And State Street and GICS identified that. They've taken advantage of it. It is innovative because it's modern technology today, packaged in a very simple form, very, very cheaply, and it brought in more money than any other new ETF last year.
Rick, I don't have to wonder about what's going on with you. XT, you were one of the original. Is it fair to say you practically helped invent the concept of exponential finance investing, or am I giving it too much credit?
No, I did. I invented the category. I went to BlackRock and asked them to create an iShares ETF based on exponential technologies, which they agreed to do. We were the early funders of it at Edelman Financial Engines. We've increased our allocation to it over the years. We're very pleased with it, and that has created a new space in the exponential technologies field. So you've got the Kensho funds at State Street, you've got ARK Investments and a variety of others, probably a dozen or two funds in this space now, which is fabulous for the investor.
It's a big fund. It's got 200 companies in it.
Yes, and it's equally weighted for exactly the reason you cited, because we didn't want disproportionate investment.
But you don't, so the top holdings, you get equally weighted. Lam Research, Xilinx, Celgene, Takeda Pharmaceuticals. So it's not a single industry. It's across many industries.
It's across the broad spectrum of exponential technologies, including globally, large cap as well as small cap.
And a small outperformer over the last couple of years compared to the last.
Yes, it's performing fine, and on a risk-adjusted basis, even better so.
I got to ask you about the Bitcoin ETFs. I know you're a major proponent of Bitcoin. You have this wonderful argument about 1% of your money in Bitcoin, but the fact is there's no Bitcoin ETF. Bitcoin has suffered from the lack of a Bitcoin ETF. Trading is way down. We've got several that are in registration with the SEC, but they've made it very clear what their concerns are. Handicap this. What's the chances of seeing a Bitcoin ETF?
It's virtually certain. The only question is when, and I don't know how soon it'll happen. The SEC has several legitimate, thoughtful concerns that the industry has to overcome, but I'm confident that they will. And eventually we will see a Bitcoin ETF, and it's at that stage that I will be much more comfortable recommending that ordinary investors participate.
And how, again, the SEC's principal concern, there's two of them. Number one is custody.
Yes.
You have to show us that you have a secure chain of custody, just like the stock market does and everybody else. And number two, overseas trading, where most of the prices are set on platforms that we don't control at all. These are not easy things to overcome.
True, but we've got some serious players. Fidelity has made a major announcement in the custody issue. We've got Kingdom Trust and a number of other very serious players on the custody side. I'm confident that in very short order, Van Eck or Bitwise will satisfy the custody concern of the SEC. Manipulation is another one. I put Bitcoin in the same category as oil and gold. Globally traded assets beyond the control of the SEC, and the SEC is just going to have to shrug and say, that's the way it is.
You have a very interesting point about the 1% argument, and we only have a brief period to do this, but explain why 1% is worth it having in your portfolio, given how volatile it is, and people say, no, you can't, it's not appropriate for my investment.
And it's because of the volatility. It works to your advantage. Instead of having volatility of 2 or 3% a day, this thing, typically you can see go up 10 or 20% in a day. We've seen 1,500% in a year. And that ridiculous level of volatility is what makes the bet, if it wins, a huge winner, but if it loses, it's 1% of the portfolio. It's immaterial.
It's really a numbers game. It's actually an interesting argument, and the volatility is the key. So if you get up, 20%, you're all of a sudden now you're up nicely for the day on that investment. But if you're down, it doesn't.
It's an alternative strategy, and the thing is, there's pent-up demand. We interview advisors all the time. 74% say they've talked to clients about their interest in Bitcoin. So they need to step up when this happens, because that money is going to go elsewhere, and you want to make sure you manage that as part of the pool.
One thing we're quite certain is the business overall is going to grow. 3.6 trillion. We've been watching it grow year after year, and I agree with the point that you've made before. Getting the 401k business. Just handicap that for us quickly. How far away are we from getting big money going in?
It could happen tomorrow.
ETFs from the 401k.
Technologically, regulation-wise, it could happen tomorrow. There's no particular motivation because the powers that be in the fund industry have no incentive to give up their market share.
And why bother? Well, that's going to be the next great breakthrough. And you're right, that'll be like the 1980s were for the mutual fund industry. Gentlemen, thank you very much. A pleasure to see you as always. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Rick and Tom for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next week, 1 p.m. on Wednesday. Have a good week.